This is Quent Bilo with a recap of key accounting concepts. Learning accounting requires a buildup of knowledge. In the first few chapters, there's some very foundational concepts. These ideas build upon each other, and a cumulative working knowledge is needed to solve later problems. Successful students need to draw upon a working memory of key concepts. Let's start at the bottom of this pyramid and build up. GAAP, FASB, SEC. GAAP are the rules of accounting to produce financial reports, generally accepted accounting principles. FASB is the private group that develops the rules, the Financial Accounting Standards Board. The SEC is the government agency that oversees the reporting for publicly held companies. They delegated the accounting rulemaking duty to the FASB. Economic events, transactions. The events in a business that change its financial condition. Assets, liabilities, and equity. The elements that define financial condition. Assets are the things owned and controlled by a business, its wealth. Liabilities, a record the business owes someone. Equity, a record of the net worth of the business from the owner's viewpoint. What's left over after subtracting what the business owes from what it owns. The entity concept, a separation. The idea that a business is a separate unit for which we do the accounting. Its assets are separate from the personal assets of an owner. The equation is our context. Everything done is accounted for within the boundaries of the accounting equation. All financial reports are cut from one cloth, the cloth of the accounting equation. The reports are connected to each other. Revenues and expenses, two very important account types that fall under the equity category on the right side of the equation. Measures of assets coming in due to sales activity are called revenues. Measures of assets going out that support the ability to make sales are expenses. These are tape measure values only, not the assets themselves. Their values reflect what's going on in the asset category. In the upward change of assets, there's an increase in revenues. A downward change of assets, increase in expenses. Note, not all changes in assets are due to revenues and expenses. Companies can borrow money to increase assets, as an example. We don't just have to make a sale to increase assets. The income statement, reporting the activity of revenues and expense accounts on a separate piece of paper. We call it an income statement. Bottom line, it reports the profit or loss during a period of time. It's a detailed report. In sequence, it's the first financial report generated. Equity statement, the second financial report, very short, explaining why the owner's equity changed over a period of time. Beginning balance of owner's equity, adding in new investments by an owner, adding in net income, one bottom line number from the income statement, and deducting withdrawals by an owner. That result produces the ending owner capital balance. An activity report developing an ending balance position. The balance sheet, the accounting equation, all ending balances of individual asset accounts, all ending balances of individual liability accounts, and the bottom line ending balance of the owner's capital, as developed in the previous equity statement. Claims against assets. For all assets representing the total wealth of a business on the left side of the equation, we'll have a claims on the right side of the equation. Not the property itself, but property claims. Claims explain which party was responsible for the existence of assets remaining in the business, either creditors or owners. The business entity owes accountability to those parties responsible for getting assets into the company, the claimants on the right side of the equation. Earnings, profits. The bottom line of the income statement reports the results of the earnings process. Historical cost, an accounting principle that states that the acquisition of any asset be recorded at cost. We just can't invent any value. It's the cost of the asset that's recorded. Accounts and balances moves into Chapter 2. They are the location where the effects of individual transactions are stored and net balances of what remains are calculated. The ingredients of financial reporting. Debit and credit. The rite of passage for new students. Learning the meanings and rules of debit and credit. They are the names given to activity in the accounts. Debit can mean either increase or decrease. Credit can mean either increase or decrease. Don't fall into the trap that they are one directional only. When an account is pictured as a T, a debit is the name of the left side, and credit is the name of the right side. Start here. No preconceptions should be formed over these two terms. Practically everyone has issues with the rules of debits and credits initially, until you interpret them with respect to the key, which is where a specific account falls within the accounting equation. Here's the key. The asset category on the left side of the equation increases with debits. Debits means left. The two categories on the right side of the equation increase with credits. Credit means right. Journal entries. The balanced mechanism in date sequence that initially records transactions. Posting. The transfer action of data from the journals to ledger accounts. The ledger. Data in journals is transferred into accounts, which collectively define the ledger. Accounts in the ledger are highly classified by 5 account types. All reporting is done out of the ledger. Normal balance. The side of an account that records increases. Since an account cannot be reduced for more than what's put into it or added to it, its normal balance will be the side that first increased it. Some accounts have a normal debit balance, others have a normal credit balance. T accounts, the basic form of an account using a picture diagram. Double entry accounting, a system of accounting that records in appropriate accounts the dual effect of each transaction. Offsets of debit and credit values are needed to keep the accounting equation balanced. This system keeps assets in sync with the general parties responsible for their existence. Trial balance, a listing of accounts and their normal balances at a given time. We'll pick up the balances discussion after you read Chapter 3. Depreciation and useful life. Allocating the original cost of an asset to expense over its useful life in a systematic manner. As assets are consumed or used up, the measured value of this declining usefulness is called depreciation expense. Various methods exist for companies to choose from. Book value. The difference between the original cost of a depreciable asset and its related accumulated depreciation entries. Book values decline over time. Contra accounts, an offset account on either the balance sheet or the income statement. Only a handful of these exist. An account that modifies another account value. Cash accounting, an inadequate accounting system that records no change in financial condition unless cash is received or paid out. This is not GAAP. Accrual accounting, an improved accounting system that records all changes in financial condition without waiting for the movement of cash, which can occur later. This course is about accrual accounting. For example, recording revenues when earned, when the work is done, but cash may not yet be received, or recording expenses when incurred, not waiting for the payment of cash. Matching principle refers to the practice of expense recognition, the timing of expense recording. Recording expenses when support efforts, meaning the cost of doing business, are matched with results, meaning revenue recognition. We don't wait for a cash payment to record expenses if we receive a service benefit today but are allowed to pay for it later. Adjusting entries. Required journal entries made at the end of any accounting period, monthly, quarterly, etc., that refreshes financial condition, keeps it up to date, ensures the rules of revenue and expense recognition are being followed. Remember, it's not about cash movements. Time periods. An assumption that accountants can chop up or divide the economic life of a business into artificial time periods. Such periods are called interim periods and allows for the reporting of profitability not just at the end of a life, but during the life of a company. Assets equals liabilities plus owner equity claims. The textbook begins with the accounting equation, and this brief tour of key terms ends with that expression. All transactions are analyzed with respect to its categories of financial condition.